Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Bill Laggner. Bill has been with me in the past, but it's been a while since we last spoke to him. I am hoping that we can get Bill's thoughts on the existing market. And Bill, perhaps if you could do me a favor, take your face away from the telephone just a little bit, because you're breathing hard into the phone, and I'm I know you're not I know you're not excited about me, but maybe you're excited about the gold markets. I don't know. We'll get to that. But just a little bit more on Bill. Bill and his partner Kevin Duffy, as I mentioned, manages the Barings Fund, which is a true hedge fund. By true hedge fund, I mean it actually provides a very meaningful and successful means of protection for people who are long the market when the equity markets head in the other direction, the southern direction. Bill and Kevin created the Barings Credit Bubble Index in 2003, which identified the credit enablers of the biggest private sector bubble over the last 100 years. And the Barings Fund capitalized on the unwind of that last bubble after the Lehman Brothers default nearly caused the entire Western world's financial system to freeze up. The Barings Fund reaped huge profits for their investors at a time when most people were seeing their equity values wiped out. Indeed, those that were in the Barings Fund did quite well and weathered the storm very well. And now the Barings Fund is anticipating the final and most devastating decline in equities that you or I will ever see in our lifetime, caused by 5 years of absolute monetary fiscal insanity. And in a note to me earlier, Bill stated, Washington is juggling blowtorches in a pool of gasoline. Wow, how descriptive is that? And I think very, very spot on as well. And so the Barings Fund is now positioned for the third and final bubble. This one will be the sovereign stimulus bubble. And that, of course, we've seen in spades with QE Infinite coming our way, huge amounts of money pumped into the system, but not real honest money, not money that's backed by anything, but money that is created out of thin air through the keystrokes of a computer. So, Bill, I'm really glad that you could join me again. Thank you.
No, Jay, thank you for having me on your program.
It's really good to talk to you again. Can you take a minute to tell us a little bit about the Barings Bubble Credit Index? What kind of things are in that index, and how does it measure? How does it measure up now compared to the prior to the last decline?
Yeah, good question. So the last go around, it was more of a private sector credit bubble mania. Of course, you had the assistance of Fannie Mae, Freddie Mac, which was, part of the necessary glue, if you will, to keep it all together, underwriting mortgages that shouldn't have been issued, et cetera. But, there were a variety of enablers. Essentially, the entire bubble was built around borrowing short, lending long, and then, creating this kind of artificial bevy of collateral instruments. And, the rating agencies played a role, the real estate investment trusts, and a lot of these other off-balance sheet, bank-sponsored products. And then today, and it was big. I mean, let's face it, we had over $20 trillion of wealth destroyed last go-around.
Sure.
Today, the bubble is really one whereby global central banks and their governments are essentially running this experiment. And last year, for example, collectively, the governments created another $2.7 trillion in new debt. That's just fiscal debt. That's just taxes less outflows, and 2.7. And then of course they're printing money all over debt. A lot of the debt is short-term debt, so it's constantly being rolled over. And you have these kind of echo bubbles around the world that are just, they're fascinating. Look at China, for example, right? We had the Chinese response mechanism in 2009 where they've created over $10 trillion of new debt since 2009. A lot of it has been kind of sponsored through this shadow banking system, real estate-oriented and/or state-sponsored entities that are trying to borrow money and roll over debt. So the game is really about rolling over debt, the central banks lowering interest rates to try and encourage viable entities to refinance debt, but in actuality not letting a lot of the misallocated capital from the last couple of cycles to really cleanse the system. and then get back to some foundation. And so it's taking just an ever more level of money printing and debt to try and support these things. And I think what we're now coming to this realization in 5 years that these things are failing. These various silos they've tried to prop up are failing, and ultimately they're only going to be able to save so much of it. Ultimately, a lot of it's going to burn to the ground.
Well, indeed, you make a good point. I mean, the last time there were sovereign governments yet that could bail out private institutions, and that's what happened. Well, who's going to bail out the sovereigns the next time, I guess, is a big question.
Yeah, and I think the central banks indirectly, if you read through the rhetoric of late, and even the IMF, the Lagarde conference in late June was fascinating. It also was after a release, I think, a 72, 73-page report where they're talking about, she mentions the word reset 7 times in her presentation, and actually talks about scenarios whereby, let's say you own a 2-year sovereign debt instrument, and the government there can convert it to a 20-year sovereign debt instrument, and then, of course, shave the coupon, haircut the coupon. They're already telling you what they're going to do for these various indebted westernized governments, United States included. And so then the question that, Jim Rickards and others will ask is, what does the reset look like? What kind of a haircut will these various currencies take, let's say, versus gold or some productive asset in society? I mean, that, I think, is the million-dollar question.
That's the big question. Of course, while Christine Lagarde and some people, there's some Fed members that are very concerned about the Fed getting behind the curve and inflation and so forth as well. I mean, there are some mainstream people who are raising some issues and have voiced some modest concern. But I would say, for the most part, Bill, when you turn on CNBC or the major media, what you're hearing is a lot of happy talk. You're hearing a lot of people say, "What are you worrying about?" They're saying, "Look, the profits are up big." I mean, I was just looking at the S&P 500, and looks to me like since 2000, going back 2009 or so, the profits are up very, very substantially. I'm looking at something like, if these numbers are correct, something like 759 on the S&P 500 to 1138 now, or something like that. So corporate profits have been very strong, and you'll hear the mainstream people saying this is why the equity market is justifiably where it is now. But I guess you don't agree. Tell us why.
Well, I think this is just another example of how, and you had David Stockman on your program recently.
Yep.
We've learned nothing in 5 years. I mean, if you look at the elements that built the last bubble, you alluded to the credit bubble index that we created. There were probably at the last stages going into 06, 07, the bulk of the corporate profits were just being generated by easy credit. The financial profits as a percentage of total S&P profits, I think they peaked at like 42, 43%. Okay, and then you looked at the collapse in the structured investment vehicles and these off-balance sheet silos and experiments. When it collapsed, corporate profits went down 90%. Well, that happened in 1929, right? I mean, you and I know the history of the crash in 1929. Let's fast forward to today. Well, a lot of the corporate profits today are finance-driven again. Of course, this is a byproduct of the American Recovery Reinvestment Act, stimulus, student loans that are not going to get paid back. And so what's happened of late, Jay? Well, you've had corporate profits decline. If you strip out stock buybacks and things like one-time expenses and the types of very creative accounting going on, corporate profits have been declining. Non-financial corporate profits have actually declined for the last 5 quarters.
Wow.
Okay, so corporate profits, in fact, you go to the Federal Reserve's website, and they actually have a graph there that shows you the profit decline, and it's a swan dive. And so people will say, well, wait a minute, the analysts and advisors are telling me that corporate profits are up. A lot of this is coming from the non-GAAP accounting that's going on, the finance-driven profits. But here's a couple statistics that I wanted to bring to your guest today. So Q2 buybacks, these are the stock buybacks, which last year topped $500 billion, which was insane thanks to low interest rates. They were actually down 20% versus Q1 buybacks. Okay, so what has been driving the last part of this bull market? A lot of it has been driven by record stock buybacks, and actually stock buybacks are now lower than they were in Q3 of last year. And yet the stock market is up 24% in the last 9 months, 9.5 months. And so debt levels are up 10% year over year, but they've actually flattened out quarter over quarter. So corporate debt issuance is beginning to slow. Buybacks are clearly slowing, and your guests would say, well, what's driving this? Why can't the stock market go down? Every time it drops 3%, 4%, people are buying the dip. We would say that a lot of this is just being driven by speculation. There is some retail money making its way into the market, but I think the professional speculator is the one kind of playing the game here. Algorithmic, high-frequency trading type programs, funds of that nature. Nobody wants to leave the casino. They just rotate from table to table. But, people don't even understand that 25% of all share buybacks, for example, the last 4 years were used for stock option issuance. So they're just taking off the stock issuance that's been granted an option. So, we think that, we are clearly the real economy is continuing to contract. The speculator economy does not want to leave the casino. And at some point, I think we mentioned this last go-around, that divergence between the real economy and the kind of the asset economy or the casino economy, that gap closed. It could close in a crash, or it could be more of a bleed. But, I think it's pretty clear to anyone that understands basic mathematics that gap will close.
All right, so you're expecting prices, equity prices, to come down substantially, I gather, over either quickly or not so quickly. But you and Kevin are positioning your fund for that event, I guess, right?
Well, yes, we believe that it's really unfinished business. So whereas there was an incredible opportunity in 2008 and 2009 to try and, basically right the ship, let a lot of things fail, let a lot of these financial experiments, these off-balance sheet, shadow bank, whatever you want to reference them as, experiments, just purge from the system, and then capital begins to get allocated more prudently, and real wealth is created once again. Of course, the central banks and the respective governments did not allow that to happen. And so we think that the earnings in many cases are more inflated than the 2007 peak in corporate earnings. And then we think that this go-around, this kind of unwind, that the central banks, I think Jim Rickards said it best, they're out of ammunition. The central banks have already taken interest rates to zero, negative in certain countries, and so they're really out of ammunition. They are trying to keep the banks liquid, obviously, but I think the real economy, the consumer, the ecosystem, they're not trusting what they see, so they're trying to hoard capital and prepare. Mm-hmm. And so as we go through this last unwind, we think actually the governments will be forced to do some of the right things and let a lot of things fail. And that kind of resetting of currencies, resetting of the foundation, if you will, that's going to be wildly disruptive to economic activity and to corporate profitability.
What would force the governments to acknowledge that Mother Nature has won? What would force them? Could it be a loss of confidence in the currency, a run out of the dollar into gold, or what might happen? Because what we have, clearly there's still confidence in the system, because you see the flight to safety, quote unquote, is into the U.S. Treasuries, a little bit into gold perhaps, but for the most part it goes into U.S. Treasuries. What would cause that to change, Bill?
Yeah, that's a great question. So, several items. You mentioned one, gold. We own a lot of gold. We own gold, some of the larger and middle-sized gold miners. Gold will just, as distrust grows around the world, gold just will become the de facto currency of choice, I think, for a lot of people around the world. And secondly, I think the citizens, if you look at some of the voting activity and the backlash from citizens around the world, people they're tired of the bailouts. They're tired of the preferential treatment given to too big to fail banks. They're tired of fractional reserve lending. Look at the proliferation of virtual currency coin. That really is just kind of is the world basically saying we're tired of a fiat system, even though the virtual currency world has its own challenges because it's not money. As far as moving through the ecosystem, people are deciding to use that versus using fiat. So there's a number of events actually crystallizing here, and I think for your listeners, it's probably going to be a series of events that force the government to they're going to have to allow some things to fail this go-around. And if they don't, if they try and just continue to bail everything out, then there will be a complete loss of the currency, and the currency will unravel.
With just a couple of minutes left, Bill, I'm not sure if you answered this question or not. I can't remember here now. The Baring Bubble Credit Index, how does that compare? Higher or lower? Or how does it compare with the peak before the last crash?
Yeah, the components would actually be a little different because some of the indices are no longer with us. I mean, a lot of these mortgage insurers, for example, have gone out of business. Fannie and Freddie, they are really just another part of the government. So if you were to kind of measure government credit issuance, sovereign issuance, then there's no doubt that the credit bubble index, because essentially we've taken private sector credit and we've moved it to the public balance sheet, globally, not just here. So clearly you're at a new high because you've created $40 trillion of just new debt, not all of it sovereign, but quite a bit of debt since the 2009 crisis. A lot of that being China, the U.S., of course, Japan. But, I would say that it's, interest rates at or close to zero clearly don't work. And I think the central bankers, one by one, are indirectly referencing that point. Now, what do they do? What is the response mechanism during the next series of crises, Jay? I mean, we can speculate at this point. But yeah. I think owning gold miners that have costs under control, that is a good place to have some of your assets. And I think, look, you could buy insurance. The beauty of whether it's something like what we do or other funds like ours, you're able to buy insurance right now on risk assets, and it's dirt cheap. And no one's buying insurance. I mean, we've got a Category 5 hurricane off the coast of Florida. We could still call the insurance company, and they will underwrite our multi-million-dollar home, and it's cheap. And yet people still don't want to buy the insurance.
Well, they don't, because I think the propaganda machine is working very, very well. And, Gibson's paradox, Lawrence Summers understood it. In fact, we're out of time, unfortunately. Maybe you can talk to Rick Rule about this. But certainly the notion that you can suppress interest rates without problems, and Lawrence Summers understood very well that if you did that, you're going to have to control the gold price somehow, because if you press interest rates down, the gold price is going to rise dramatically. Well, it certainly hasn't done so in the last couple of years, although I think we're still in a secular bull market. In closing, would you agree with that?
I would completely agree with that. It's all about trust, and I think people globally are losing trust in the system just because of the various, as I mentioned earlier, the various insane policy decisions, fiscal and monetary, taken by westernized governments the last 5 years.
Yeah, indeed. Well, out of time, Bill, thanks for joining me today on short notice. It's really good to have you, and look forward to doing it again sometime in the near future.
Absolutely, Jay. You have a nice day.